Hi, welcome back. Episode 4, exploring the process here. You got Chris and I, the original twosome. We'll have guests back on next week. And I think we're going to kind of go back again to the day in the weekly notebook review, kind of try to take it back to the beginning, right? In terms of just a bit more macro picture, that kind of stuff. I think this episode, we're going to kind of do the same thing here with exploring the process and, go back and reiterate some things, that we find are really important in our process, and hopefully you'll find them valuable as well. So I know Chris got a couple of things on his mind, so I'll pass it off to him.
Yeah, so I was re-listening to the notebook review last night, and some of the big things that came up, especially at the start, was around this kind of thing of, if you've been with the process for a while, you've kind of accrued some gains that you can almost sit back on, and you can give yourself time. That's definitely where I am. I came into December where I'd pretty much taken everything off the table. That was a personal choice, just because I wanted to concentrate on something else. I had work I had to concentrate on. I didn't want to have to manage the portfolio separately, because I know I'd do both wrong rather than, instead of hashing them both. Yeah. So, and I know it's not going to be the kind of thing that people want to hear, but especially if you've not long subscribed, we just spoke a moment ago of this, you've just put down a lump of money for a subscription. If it's off the back of, the big marketing day that they've recently had and stuff like that, it's kind of not the thing you want to hear. That you want it, you kind of need to take it steady, especially right now.
Yeah.
The setup that we're coming into is, you could kind of screw yourself up by piling in. And one of the things that came up, one of the things that I really picked up on was, Gavin said, kind of coming out flat over the next 3 to 6 months. If you come out with your account the same as what you started at in January, then you're going to be beating like so many other people that are kind of, as we're going through this period. And that's kind of not the thing people want to hear. They put this money down for a subscription, and they kind of want it to work straight away.
Right.
I joked a minute ago, you don't go into the Apple store and buy a MacBook and they say, in 6 to 8 weeks, it's going to really work.
Right.
You kind of want to take it home, take it out of the box and press the button, and it will just work straight away.
Yeah.
But that's not really the position where we are. I don't know did you pick up on that from last night? Or
I did. And
people were talking a lot about cash positions, and I don't know whether, not that people didn't like it, but cash is a position. It's optionality, isn't it?
Correct. And it's challenging though, right? Because to your point, I mean, being plus or minus 1% after, subscribing to, this awesome service is not something that really is gonna wow your partner, being like, sweetie, that was great. That was a great purchase, right? I mean, 6 months later, 3-4 months later, we saved our capital, but we haven't exactly, compounded it. But that's the thing, and Freebird mentioned this too. There's points in time, and there's points in life too, that where, you can get aggressive, or you can get, you can kind of go, you can kind of turn it on a bit more, right? So, whether it's in the day, in work life with your kids, traveling, whatever it might be, right? In the portfolio, there's times where you're like, let's go, let's rock and roll, right? You're every weekend for a month, you're just on the road and you're going camping and you're going to the beach, whatever it is, right? You're all over the place. But then there's other times, where you just, you got to kind of rest, and you got to take care of the home, the home and the house, and you got to do, you got to repair the well, or in my case, the sump pump broke, 2 weeks ago, right? You got to also do that stuff. You can't just always be, snowboarding and all that kind of thing.
That's the bit that sets you up for the next
correct.
jump, right?
Correct. Yeah. And so I don't know if that analogy is really that good, but the cash is a position. And I think the other thing too, again, I don't want to, I know we're not kind of picking on Gavin, but he said something about how he rode Google, right? And he rode Apple. And I think many folks, like, we rode tech. I mean, when I closed out energy in December, my last, like, basically, purchase date was back in December of 2020. So I rode that for an entire year. I mean, it was 50, 60%, it was 50, 60% gains. So, you know, I have that benefit. Now, again, I mean, I have losses in there too, right? I mean, I've been very frank about, you know, I held small caps for way too long post like June, you know, I like, but I cleared that, you know, I cleared the decks over the last few weeks, and it's been freeing, and it's been, and I think just having that ability not to sort of bog yourself down with some losers, or with a lot of losers. In my case, I had a lot of losers. I went from like 80 positions to 25 to under 25 now, right? And one is easier to manage in this like volatility, you know, it's a yo-yo going from one end to the other in terms, and again, it's just math, it's just probability going from, you know, in this case, most recently, you know, VIX 22 to VIX 32, right? Or vice versa. But it just having that humility of just being like, I'm wrong. I need to start fresh, and this is a good time to do it, because whether it's selling them now, again, who knows if we're going to have another 20% drawdown? Like, that's not really my call. I'm looking at, you know, we both approach this as like, you know, kind of with the, call it a 3 to 6 month kind of time frame. You know, and we go off of what the signals in the market are really trying to show us, and to sort of, you know, try to front run those, just like Keith would say, right? Trying to front run the machine. And so, you know, getting rid of them now, this is the way I'll just tell you how I thought about it, right? I got rid of them now because if we do have 20% drawdown, then I want to be able to have a clean deck to basically do, you know, to take advantage of, you know, massively mispriced assets, like we talked about on the notebook review last night, like McDonald's, you know, maybe Facebook's down there, who knows? But you know, you probably get some REITs down there, right? You have really high quality, you know, equities, even like some, you know, even if you want to take a flyer on some weed stocks, right? They're going to get pounded too, right? So you thought, you know, cutting a loser down, you know, 60, 40, you know, whatever, 40, 60, 70%. Well, you might be able to catch it for like pennies on the dollar next, right? And so having that capital to basically be able to then, you know, again, like think about it. I mean, the way, you know, to really capture excess returns. So not only do you not have the drawdown, but then you're picking, you know, again, you don't even have to pick the bottom. You can wait 5, 10, 15%, make sure that, you know, volatility is, you know, creeping lower or whatever. It's not going to be clear. It's not going to be clear, but you can then capture a lot of upside as well. And that's the way I was thinking about it. And yeah, so
I think so. I've stolen this. It's probably going to be terrible without a chart, but if you take a sine curve, so take a graph, draw a sine curve on it, and you have just split it from 0 going to 10. And I like the analogy. I don't know who used it. I don't know if it was someone in Hedgeye or someone completely separate, but he's talking about, you're not trying to pick the bottom. You're not trying to buy it at 0. I mean 0 on the graph, not 0 in price.
Yeah.
I want to try and buy it at 2, maybe 3, ride it all the way to 10. And I know I'll never sell it at 10. I'll never get out right at the top, but I will get out by the time it's transitioning on the other side from 9 to 8.
8, yeah.
So I've rode it from 2 to 8, and I've got the main chunk of the move.
Exactly.
Yeah, I always like that analogy.
And even right now, again, you play a lot, you know, you're in the UK. It's hard for those that don't know, you know, Chris, I believe everybody should know this, but he's outside of London, and you know, he focuses a lot of, you know, he obviously has a keen interest on the US because it does, you know, it's the global market, et cetera. But, you know, in terms of a lot of things that he, in terms of like invest in, Chris, I mean, correct me if I'm wrong, but I know it's a lot of FX, it's a lot of gold, and some other European assets, right? Like it's in terms of like what you're doing right now. Yeah. And whereas, you know, I'm definitely short selling. I'm not really currently playing FX, although it's getting to be more and more interesting. I've basically paper traded FX for the last 8 months, basically since June or July. And I've gotten more comfortable with it, but I don't know. Anyway, it's different. That's a different beast, and we could have a whole nother conversation on FX, asset allocation and trading. But the point of my statement here is that the position sizing still remains crucial, right? So I am shorting, but I'm not like I might be net short in my book or like in my portfolio, but I'm not taking, like, for instance, I shorted Facebook yesterday, right? Going, over the last 2 days, right? So that was a big winner for me today, right? It was awesome, pat on my back. Good job, Robbie, right? But, I still only took it to 300 basis, but, I took it to my max. I took it to 300 bits, right? Like, it's not like I took it to 12 or something, right? And got all outside, out of whack. And I think that's really important. You got to have your rules. If you don't have rules, you're going to get fucked. Because
both ways, up and down, because
correct.
It's always so I kind of selfishly started the videos that I make. I kind of selfishly started to do them because there was lots of, I don't want to say stupid questions, there was lots of the same question coming up on the macro show queue. And selfishly, I wanted more interesting questions. I wanted to pull more information out of Keith and whoever was doing the macro show on that day, rather than going over the same questions. But then on the flip side of that, you get so much information from the queue of how people are thinking. Whereas, like, everyone's always had that, it's constantly been whatever asset it is, or it's constantly been at the top of the range and we haven't had a chance to buy. And it's like, that's setting off triggers in my head straight away. It's like, right, okay. So
like the dollar's kind of giving that setup right now, right? It's like, a hair in terms of, it's how it gave you a look the last week, I think it was, right? But then
it's down. It's actually down a lot today.
Oh, is it down a lot today? Okay, so never mind.
Never mind. So you've got your chance, right?
Yeah.
But then at the same time, saying about signals, that's saying like gold's actually gone down as well. So
never mind.
No, just in terms. No, but in terms of that, it's
you don't get enough. Yeah, you don't get an opportunity to buy it when it's moving higher, right? And then you're selling at the top of the range, so you're trimming it, and then you kind of fear of missing out, right? And you're getting. But then on the flip side, if something's kind of starting to move against you, and you're picking it back up incrementally, but it doesn't start to move again, that to me that becomes like a decision in your own capital, right? Whether or not you want to hold on, give it some room, some breathing room, or do you, again, I think this goes back to like having your own process. Like something's moving against you and you already have a 2% position. Do you take it to 4 or do you take it to 3, right? Or do you take it to 5? Like that's a personal decision. And then, do you, if it catches a bottom, or kind of if it starts to improve, the signal starts to improve, then you go from 4 to 6, or do you go from 4 to 5, or 4 to 4.5? Yeah. Like you go from 2 to 2. Like it's all personal, right? So that's where it's like you and I can't tell anybody how to do it for themselves, but and sometimes it works and sometimes it doesn't, right? It's like something like you can get big at what you think is going to be the bottom, and then like again, I'm like energy was a good example for me. Like oil, like I shorted oil at thinking OVX was 41. It looked like it was going to move higher. We were at the top end of the range, but that range just kept moving higher, and so I did finally cut it like a week or so ago. But it just, you can't, like I was giving it room. I gave it like basically a month to breathe. And because I was like, if it's going to start to work, it's going to start to work. Or like, I can't expect it to work on my time frame. Just because like I thought something didn't, and it didn't work, doesn't mean that necessarily I'm wrong. But it doesn't mean that I'm wrong in the moment. Coach Keith always says like timing matters, and it timing and sizing, right? They matter. And I think that's again, that's a huge component to that I've had to learn over the last 2 years. And
I think, no, go on.
No, just
I think for me, a part of that is like love him or hate him. I listen quite a lot to Jordan Peterson.
Okay, yeah.
Okay, and part of what he says is even having a bad set of rules
There's
is
still
better
rules.
than having none at all, because it allows you to kind of, what he's saying is, even having a bad, or an aim, having an aim of this is what I want to do, or having a set of rules that are wrong, each step you take, whatever, this isn't a price chart, I'll just mean like each step you take, you're like, right, I need to change that rule's not right, it's not working, I need to change it in this way, and then you keep moving, and then you figure out, and then 3 months or 6 months or 6 years down the line, you're like, right, these are my 10 rules,
Correct,
written down, I have them in front of me, I have to tick all these boxes before I enter a trade or reduce or whatever. Otherwise you're just shooting from the hip, aren't you? You just kind of, oh, this looks like it's doing that, and now I'm going to just.
well, it also too, I think, if you got 100, right, so like there's sort of I remember Keith mentioning at some point, it kind of like 12% drawdown is kind of where he doesn't ever have like an official stop loss, is what, if memory serves. But again, I'm not trying to speak for him, but I don't believe he ever really has a stop loss, but he has this sort of like line of like 12%, and that down 12%. And it really stems off, he shared this tweet, which I loved. This is probably a month ago, but it's basically all the different like levels. Like if you're down 10%, how much you have to be up, like basically the plus minus, right? In terms of like, the other day on the macro show, is like if you're down 20, you got to be up 25, right? That's an easy one to remember, right? So down 12, it kind of gets at that threshold. It starts to, the amount you need to be positive to make up that capital starts to really expand and get larger. And so I suspect that's why he has the 12% in mind. And so if you think of like 100% of capital, if you lose something, so if you put everything in 100% and you go to 88, it's a lot easier to get back to 100 over the course of weeks, right? A month maybe, right? But because if you're constantly, so now you got 88% of your capital, right? And again, I'm not going to butcher this math, but let's say you go up, 10, you get it back up to 90, right? So all of a sudden now, but then you got a 12% drawdown again, right? Well, 12% of 90, 12% of 90 is less than 12 of 100, right? So, you're still constantly kind of, in that relative range where you can make up for the losses. And then same thing on the upside, right? So if you're taking gains, so if you're max, let's say you didn't take something to max, right? Energy is a good example. I don't think I don't know if I ever really took it to full 6, because I just stupidly didn't kind of pay up for it, but it certainly grew to 6, right? And then grew more than 6. And that was my rule, right? So like now, once it got to 6, even though I didn't necessarily buy more, but the value of that, asset allocation grew such that, I trimmed it just to 6%, because again, it was like, you could see the trending, it was, just anyway, it was, so I think my point stands, where it's just like all of a sudden now, and then as things turn, you're like, okay, I'm going to go from 6 to 5 or 6 to 4.5, right? So I'm going to sell 150 basis points. So now you've got a process and like a template in place where you're not only trying, it might not be the best system, but you're minimizing, or you're trying your best to kind of minimize losses, or at least cut your losers. And then you're doing your best too to kind of like capture your profits and to help sort of like meld those two together. And it's a hard concept. I mean, one that I probably really haven't executed well on until the last like 3 weeks.
It's because it goes against almost every, like, I know there's 60 guys and girls at Hedgeye or more now, but at least that I've seen, it's kind of the only voice that talks in that way. So if you've got, I mean, I only follow, like, I think I follow 18 people on Twitter now, but when everyone else is just this big cacophony of like telling you what you have to buy, and like, this is a great place to buy this, it's like none of this portfolio construction is ever really talked about. So it's just this cacophony of telling you what you need to buy.
Correct.
So I guess that's the kind of unlearning part, right?
Yeah. And on top of that, you're most folks only show their winners, right? They just say, okay, I bought this I bought this put option on Facebook yesterday, right? For, whatever, $6, $6 put option, and today it's worth 55 or whatever. I don't even know where it is today, but basically, it's like I made 2,000% returns today on options trading, and it's like, well, yeah, but like, is that on 10% of your capital? Is that on 100% of your capital? Because that's on 100% of your capital. I would like to sit down with you and help you out, right? Because
and he's been buying puts on it every week for a year.
Exactly. Now again, there's some like awesome services out there, or like awesome, there's some great traders and guys that are trying to coach up the retail community, and that kind of thing. But at the same time, to your point, yes, like it's to put getting and Trent Wizzo touched on this last week. It's like he almost puts as much time in the setup and the process of getting like from A to pushing the button to either buy or sell something. He puts almost as much energy and time into that than he does in he puts in probably to be honest, he probably puts in like 3 to 4 times as much energy in that versus actually hitting the button and then managing the portfolio. I could be wrong there, but it's like, there's so much. You do it the same way. You're very similar in terms of, you call them your janky sheets. I think I'm pretty impressed by them, but you've worked so hard to build various components of back tests and to help you with understanding, okay, where do I need to go and where do I need to go to get to maximize to maximize my capital allocation. And you said this, that like quad 4 is like one of your most epic like quads that you have to get right, because it's one of the easier ones for you from like an FX standpoint, and gold works and other components too, right? So everybody's got a little bit of a different game or edge that they need to take advantage of. I was thinking in the shower this morning about quad 4. I love quad 4. It's like it's weird how much I love. It's weird how much I love quad 4. Like I love quad 4.
I think and I think Freebird and was it Howard Penny?
Yeah,
I think they both touched on is, if you can get through this bit, think about all the stuff that you'll be able to buy on the other side of it.
Yeah, exactly.
It's like if you I don't know. And it was funny. I answered someone on the arena on the forum this morning, and it's always hard with text about reading context, but it was kind of like, what, you don't do equities? Well, what do you do then? It's like there is other stuff. It's like there is other stuff. So I'm going to butcher whatever numbers, but it's like, if you liked Facebook at 175, imagine what it's going to be like at 75 or 55 or 25.
Yeah.
It's not going away. It might be different. It might be, I don't know. A regulator's not going to regulate it when it's at 175 and everyone loves it, but when it gets to 25, are they like, well, now we can go and stand on the neck of this thing?
Exactly.
Right?
Exactly.
Because everyone hates it because it's gone down their 401k and stuff.
Yeah.
I don't know, but that's the thing. That I think that came up last night as well, about prepping a shopping list, right?
Completely. And that's where, the call, right, becomes, to me, it's actionable today, but then it's actual as well if you kind of try to pick up and listen to the tone and the nuances of what the analysts are saying about, like, okay, something you might not want to be long this right now, right this minute, but make sure you're paying attention to XYZ security, because there's going to be a time over the, basically on a, call it 6, 12, maybe even 3-year, tail duration, that you're going to want to be long this thing, and you want to be long it at a better price. So like, a couple, like McDonald's is one that Penny was talking about yesterday, right? It's like, it's got to, it's digitizing. It's first time, the fundamentals are great in a quad 4, and then it's also the first time ever that it's basically it's digitized itself. And so it's got a kind of a good quad 4 fundamentals, but then it's also pulling in, a bit of a potential growth kind of factor exposure, if you will, right? That could really, which is somewhat unusual, or at least historically from a backtest standpoint. Like, I don't think you'd consider McDonald's a growth stock, but yeah. So I mean, those are the things that to me, you got to be. That's got to be also part of your process. It's like it's not. It's some of it is today, right? Like Ralph Lauren is a good example where McGough yesterday mentioned it on the call, right, that Ralph Lauren, if they put up a good number, it's going to be a quad 2 number. It's likely the last positive earnings that they're going to have. Let the dust settle, but then short the shit out of it, right? And because they're going to have, they're fundamentally, they're running into really tough comps, right? And then fundamentally, they just have a kind of their legacy products. They haven't evolved, and they're just in a tough spot. And so you get almost like the flip side of McDonald's, where you've got they're fundamentally weak, or like running into headwinds, and then also have really tough comps because of the COVID comparisons and the stimulus checks and all that kind of stuff, which is hitting Facebook and all these a lot of these other components. It's just it was briefly mentioned last night, but I mean I think Howard mentioned it, or it might have been Freebird, but the like stimmy checks, I mean, this is way different. So like the comparison was, I believe, against 2018. I forget who meant this, but the comparison was against 2018. But like
the comps with the
with like the act, the
like
CARES
Act,
Trump
tax cuts.
I think it was like the tax cuts and the CARES Act, I believe, right? And then this, I mean, what the U.S. did for the pandemic, like dwarfs those those stimulus packages, and therefore you could just be a lot more pain. Now, again, I'm not like a doom and gloom guy. I'm just trying to figure out where we're going, or to the best of my ability. And I often suck at it, right? So like, but yeah, it might have been Mitchell. It might have been Mitchell who said that other side of asset management. But anyway, it doesn't really matter. But yes, the point is like, if you're doing the work now to position yourself for the future, whether you think in the moment it was a good $1,000 expense, I'm pretty sure in the years from now, you're going to be very grateful that you've put in the time and the effort to try to get your process right, to then try to compound your returns even more so than you would really anywhere else.
Yeah, for sure. I mean, if nothing else, there's I won't say which company. There's a production line, and it's the largest. What would it be? Largest soda company in the UK has a production line which adjusts its output based on volatility. So even if you don't make any money, you'll learn something. All right. So plastic bottles of soda. So the fastest machine on that production line is the labeler. So if it goes wrong, it can create havoc for the rest of the line. So now I've programmed it so that if the volatility breaks out of the output, it slows the filling machine and everything in front of it, slows everything down until it gets itself sorted again, and then it speeds back up again.
I like that.
But very good. So even if you don't make any money, you definitely learn something.
I mean, yeah. This is. I think most Jedis have PhDs in. They could teach pretty much at any college, university around the world, and provide some youngins with some really good investment knowledge. I don't think you or I are quite there yet, but certainly the goal. That's certainly anyway. But good stuff. Anything else on your mind, or?
The only other thing, just quickly, was about short selling. I think the flows that make everyone look really good as you're going up. Just the whole structural thing of everything, if you get into the whole Mike Green, and even like slides, like one of the first slides on the macro deck is, whatever it is, like page 3 or 4 is showing you ETF inflows against the mutual fund. Yeah.
Yep.
Everything that makes stock pickers look really great on the way up.
Make short sellers look really good on the way down.
But timing, you have to time it, because you're now, instead of you being lifted by this flow, if you are shorting on the way down, you're having that flow is still coming. It might be reduced, but just so long as the world doesn't stop, people are still getting paid, which means that money is still going into their pension or their 401k. So the money's always going in there. Yeah. So the timing in how long you hold your shorts. Yeah, you have to be, at least for me, you need to be much more strict on timing.
Yep. I've got a date in my, it's Mike Green, Professor Plum. He mentioned basically typically starts around the 23rd of the month. Now, again, that gets adjusted, right? Obviously, we've got a short month here in February, but just keep that general number in the back of your head, because that's typically when the passives or the rebalancers will start that process. And if you look at the flows going back in January, you can see that. And then it obviously picked up massive steam kind of last 2 days, 2-3 days. So, Friday, Thursday, Friday, and then Monday, obviously, right, to kind of finish it all off. And yeah, it's really, really important, because if you aren't taking profits, you're going to see those evaporate. And you're going to be really pissed because you were right, and you're right for the right time, but then you didn't cover at the right time. So, in a market, again, I believe we are headed this way, but typically in this choppy market, or certainly when you got VIX above 25, certainly north of 30, you're going to have opportunities almost anywhere. So kind of cutting, if you take a 2, 3, 4, again, you take a 1, 2, 3, 4, 5, 10%, profit, and you just cover, that is very, very good, because you can either rotate it into something else that's at the top of the trend, or you just pause for a second and you let kind of that VIX creep back down towards the low end of the range, and then you just go big again, right? And maybe covering is a form of buying, right? So maybe you just take it maybe you go one other step, and you actually put in a little buy order for stuff that you want to own, like a McDonald's, or like Staples, or utilities, or whatever is at the, again, it just depends, right? But you if you're playing both sides, if you have the ability to play both sides of the coin, of the game, then you're upping your optionality and your probability of success. Now, again, not everybody can do it, and so if that's the case, maybe just stay in cash until volatility is kind of peaking, and then dip your toe back in, whatever it is, right? So but it is those passives, that's what kind of basically it creates these bear market bounces.
Yeah, exactly. Yeah. Awesome, bud.
Well, this is a great episode. So this was episode 4, exploring the process. Next week, we're going to have a really special guest. I'm just confirming time, making sure I want to leak it out here quite yet. I want to make sure that he is available, but I suspect I believe we're pinning him down, and it's going to be focused around crypto, and sort of how both Chris and he have leveraged sort of the Hedgeye process over the last few quad twos, really, for the last kind of 18 months, to kind of get more acquainted with crypto, and taking that portion of the process and applying it to the crypto world, crypto space, and that kind of thing. Everything from Bitcoins to shitcoins. So should be a really fun conversation. We're excited to have him on. So I'll tease him out if I get confirmation later today, or by the time we release this, I'll tease it out in the tweet and stuff like that. But hopefully we'll be able to lock him in next week. All right, Chris. Thank you, sir.
All right. Cheers, buddy.
We'll chat soon, bud.
Yep.